Hi, my name is Said and I want to teach you guys a little bit more about Forex trading. Today's lesson is going to be about strategy, risk management, and the psychological part that comes with Forex trading. Now, I know what you're thinking. It's easy to do this and do that, but when it comes down to the actual logistic of it and actually doing it and proceeding with the action, it gets a lot more difficult, especially with Forex trading. You don't have someone that's going to manage you, someone that's going to tell you what to do, unless you're in a course. If you're in a course, then you should have a person that's guiding you at least. But if you're not in a course like most people, then you're just on your own and you don't have a boss to tell you what to do. You don't have someone to tell you to wake up at 3 a.m. to hit the London sessions. You don't have someone to tell you to wake up at 6 to hit these markets. And in general, it gets a little confusing whenever you want to start a strategy and you're not following it to the T. So yeah, today's lesson is going to be about strategy, risk management, and the psychological part that comes with trading. When I talk about strategy, I mean, what are you going to be doing in that very day? If it's a Monday, are you going to be trading your USD? Are you going to be trading JPY? Are you going to be trading any other market? You should have that written down. Are you going to be trading monthly, weekly, daily, 4 hour, 5 hour, so on and so forth, 4 hour, 15 minute, 5 minute, all these different time frames? Are you going to be trading the bullish or bearish markets? Are you going to be trading for trends? Are you going to be trading for dips? Are you going to be trading for anything like that? All that should be written down and all that should be planned ahead so you don't go here and there whenever you're trading. Everything should be congruent with your edge. Your edge should be the strongest thing because us traders, that's all we have. All we have is our edge. That's what the casinos have over us. They have edge over the player. I just want to shortcut these little lessons and explain it to you. I'm going to go more in depth with risk management, maybe in another video, but risk management is pretty self-explanatory. Now, when I talk about risk management, you know we're talking about money. You need to learn how to manage your money in a more efficient and effective way when you're trading these Forex markets. Because the last thing you want to do is get stopped out on a few trades and you're already down $500, $1,500. You're blowing up your account. Everyone's making fun of you. You look stupid. You do not want to do that because you're gonna make a fool out of yourself. Okay, so right now I want to teach you guys about ratio. Ratio comes into play whenever you're doing risk management and strategy. You should have a proper ratio of at least 1-3 or 1-2. I suggest you doing 1-3 and no more, no less, because you're more likely to succeed with that, but it's also harder to trade because you're more likely to get stopped out whenever it comes to you trading lower percentage or things like that. So let me explain to you what I mean by ratio. Okay, now I'm going to show you guys a little bit more about ratio and explain what I mean when I talk about ratio. When I talk about ratio, I'm talking about wins and losses. When you have a 1-3 ratio, I'm going to assume that I hope your losses are 1-3. You lose one time, you win 3 times. Now when I talk about that, I'll give you an example. Okay, this is the example that I'm coming up with right now. Let's say you lose 3 times consecutively. You hit your stop loss 3 complete times. You're minus 3 in your account, not dollars, just in general. You lost 3 trades, you're minus 3 trades. You win 1 trade, you broke even. Okay, you're at 0 wins and you're at 0 losses off of 1 win. You lose another trade, you're like, oh dang, this is a bad week for me. You're down 1 trade. You think you're about to hit 3 consecutive more losses, but you end up winning another trade. Now, you're +2. You've lost way more than you won here. Picture yourself getting a win and another win, and then maybe a loss. That's going to be consecutive profit. Now, what comes difficult with this is sticking to the actual plan, because a lot of the times you're going to see your stop loss get hit, but you're not going to let your target get hit. So you have to stick to the plan whenever it comes to these ratios. Because if you have a 1-3 ratio, your trade is, I'm going to assume that you use TradingView because I like TradingView. I'm just going to show you a systematic thing that we use on TradingView. This would be a 1-3. Not exactly measurements, but this is how a 1-3 trade would look like. This is your green, this is your green, and this is your red. Red means your stop loss, green means your profit. Now, if price comes up, does like this, okay, you see it coming halfway up the board. Price comes down, you take profits, You cut it right here. You think price was about to go down. You think price wasn't going to come back up. For some reason, they started consolidating, started doing this and that. You're like, okay, I'm going to take my profits. I'm going to be smart here. You took your trades at a 1-to-1 here, not a 1-to-3. So that means that you're messing up your strategy because you didn't let your target hit to your 1-to-3. Do you see what I'm saying? It's a 1-to-1 because you cut this in half. And now, if you would have lost that trade, it would have been broke even if you would have won it, because you already won the 1-to-1. You turn this trade into a 1-to-1 by taking it a quarter of the way, or 30, 45%, whatever. You know what I'm talking about. This is exactly why there's 95% of losers in Forex trading. This is why a lot of people go bankrupt and they blow up their accounts. They don't understand the simple psychologicalness, I guess you could call it that, of the Forex market. Now, I'm going to explain to you guys more about risk management and how you could use risk management in your favor. Let's say you have two people. You have Tim and you have Tom. They're both going to have a small account size of $1,000. To reiterate, they both have $1,000. Tom wants to be a little smart and risk 3%. Tim, on the other hand, he wants to be ballsy and he wants to risk 10% of his account for bigger gains. Now, what Tim doesn't know is Corona happened. Tim didn't realize how to trade during Corona, and he's been taking consecutive losses in the market. Tim loses 5 trades. He's down $500. 10% of 1,000 is $100. He's down $500. Now, do you see how this looks, guys? Every time Tim loses, he's losing $100. And whenever Tom loses, he's only losing $30. So, if Tom loses 5 trades, he's only losing around $140.
Guys, I meant to say 150. I'm sorry.
Tom can keep going because he could hit his streaks and he could keep winning. This is just straight losses. You could get a W in this and make this an even smaller loss. Now, Tim, on the other hand, if he wins consecutively, he will reap that. Reward. He'll get money, but not in the way that he wants to, because eventually he's gonna lose. Everybody loses in the market. It's normal. It's good, actually. You learn whenever you lose. Tom, on the other hand, he could take some losses. He could take a lot of W's with that 1-to-3 trade. Okay. And that goes to say, if both these people follow the strategy that they put up for themselves. If they don't follow the strategy, then they're not going to be professional traders, because they're going to be random traders. They're going to be the casino player, and the market is the actual casino. Said with that, I hope you guys understood that a little bit more. I hope you guys didn't even know that information. I hope I just gave you some sauce. I really want to talk about when people see their trades that are losing. Whenever a trade is losing and you see that you're up profits, if you're not trading, you probably won't understand this, but psychologically, that really affects your mind. And you see you're going up on the charts. If you're in a buy trade, you see that you're going up. And next thing you know, you have structure set in to where you don't want to see it break your trend. This is your structure box, okay? You don't want to see this break through. If this ends up breaking through, then you want to cut out that trade, because you already got an entry right here, and now you're down halfway profits and you're getting shaky. You're like, oh no, I'm about to lose all this money that I've already gained. So you get out the trade. More than likely, the trade will come back up because trend follows trend. Of course, trend breaks, but there's more times that trend will follow the trend other than make a complete reversal out of nowhere. Of course that happens, and of course that's great because that's volatile and we make a lot of money during volatility. But this is not a professional way to trade, because this does not go with your 1-to-3. Follow the 1-to-3 trading method. More than likely, this trade is about to retest this structure box, break down a little bit, and come right back up. Next thing you know, some other guy in Nigeria just got 10K, and you're settling with you're settling with $5,000, $500, whatever your account size is. You're settling with half money, and the actual people that are trading professionally are settling with the millions, and they're riding on yachts, okay? You're driving around in a hoopty. Okay, so I just want to explain that real quick. This is extremely important. If you don't understand this, then you should really get on top of this, listen to what I'm saying, write down what I'm saying. Honestly, trading is extremely easy. 80% of trading is just psychological. 20% is actually learning the charts. Like, I'm being dead serious. Yeah, I just want to thank you guys. Leave a like, subscribe, come back for more.